Well, let's digest all of what's happened today in the markets with our market panel. Let's bring in Ghabour, KeyAdvisors Group and author of The Common Sense Bull, and Joe Fahmy, Zor Capital's Managing Director. Thank you both for joining us. Joe, I want to start with you because you list a number of factors needed for the market to turn around. We've seen from one day to the next, these wild swings. Looking at the main factor you listed, improvement in growth stocks, which ones are you focused on now versus some of the lows you saw due to the pandemic in 2020?
Yeah, no, that's a great question. Just to review, I've been bullish since the pandemic lows, and the main few reasons is that growth stocks were looking good, the institutions were coming back into the markets, and the Fed was providing an insane amount of liquidity by not only keeping interest rates low, but they were doing a lot of treasury buying. They bought more treasuries in the 6 weeks following the pandemic than they did in the 9 years combined between 2009 and 2018. And then they continued with their 120 billion in bond purchases per month. Now, I stayed bullish during that trend, wrote about it for your website. And then in about mid-December of last year, I turned cautious for the opposite of those reasons, where growth stocks were breaking down, the technicals were breaking down, and the Fed was turning hawkish by not only talking about raising rates, ending their bond purchasing, but possibly even reducing their balance sheet. So I've stayed cautious since then. I've kept a heavy cash position for my clients, and I wrote about on your site, we need 5 things to see a new sustainable uptrend, and one of them is growth stocks. And the reason growth stocks are important is because that's an area of risk appetite. So what am I looking for specifically when I screen the market and when they show up as they did around the pandemic lows? I'll let the market lead me into it rather than trying to guess at this point, because right now a lot of stocks are in a corrective phase.
Eddie, I want to bring you in here. You said in your notes to us that this is the most cautious and concerned you've been in your career. Why is now so exceptionally concerning, and what does that mean for how you've been investing?
So look, I think we have to look at where we came from. You know, we saw one of the fastest increases in bubbles last year due to what the Fed did, due to loose monetary policy. And we saw the economy really accelerate at a historic rate. And now the setup coming into this year, which is why we became very cautious at the beginning of November, is literally the complete opposite. So these bubbles are going to have to come unwound. We are going through a deleveraging process right now. And so I'm very concerned because I believe a lot of investors did not make moves. They think that maybe because their stock is down 20%, that it can't go down another 20. And that's very concerning to me because the bottom line is I believe we are now in a bear market. It's going to trade like a bear market. We have the economy decelerating at a very fast rate due to the inflationary pressure. When you put the Fed tightening on top of all of that, I don't see how these risk assets can't go down another 10 to 20%. So we have raised cash. We've gotten completely in our tactical strategy where we risk manage for our clients around their core holdings. We got out of technology. We got out of small caps. We have a good cash position. We've been buying precious metals, bonds. We've been buying bond proxies on dips. So we are playing it very safe. Because again, we are in a historic time period right now. And then you put a war on top of all that. There just aren't a lot of reasons to be bullish right now, unfortunately.
And so, Joe, shifting back over to you, if we are in a bear market and it's just not showing up in the tape as of right now, but perhaps once we start to get some of the further guidance from companies in the next earnings season as well, where would you expect some of the institutional buying to resume?
Well, I just want to stress, I agree with Eddie's point because sentiment right now is a little bit it's starting to get bearish, but there's a difference between what people say in surveys and what they actually do with their money. And a recent Bank of America survey is showing that people are bearish, but they're not selling anything. So I agree with Eddie that we're in a bear market. The heavy selling right now we're seeing on the down days is heavy volume, showing that the institutions are still exiting the markets. And then when we have these snapback classic short covering rallies, it's on light volume. So I think we need to get some clarity from the Fed at their upcoming meeting next week. And then we'll have to just wait and see where they're putting money to work. Right now, the only consistent money, the only sectors that are acting well are energy related and commodity related. And I still think they're going to continue to do well. As far as tech and other sectors, they're still in a downtrend and still correcting. So we need to be patient until we see where money's going to be put there.
Eddie, you're bearish on stocks. How bearish are you on the economy? And do we get a recession in the near term?
I do. I think right now, when we take a look at this data as it comes in each week, and inflation coming even hotter than what we were anticipating, that I believe next year we're going to be looking at a recession. Now, what that means, in my opinion, is the market will bottom before it's a technical recession. So I think we could have some amazing buying opportunities in the fourth quarter of this year. But I think right now for investors, patience is really hard to do because cash burns a hole in their pocket. But I think being patient here and letting things play out, because I can tell you right now, if the Fed really does raise rates 4 to 6 times like many people are predicting, this thing can get very ugly very fast. And that's when you have bubbles burst. That's when you have the VIX in the 40s. And that's when the bearish sentiment matches the selling. Because again, I agree, it is not bearish enough in regards to when you look at how people are positioned. So we need to get that capitulation first before I'm willing to jump back in with our client assets into those high risk and high beta plays.
And Joe, I want to bring you in here. As you look at how the retail investor is reacting versus the institutional investor, how should they be doing this? We're seeing a lot of panic buying, a lot of buying on the dip, even though, as Eddie, you're saying, we're still only in the middle innings of this market decline. Joe, how would you see retail investors taking this at the moment?
My feeling is that retail investors are still buying the dip. I've always said the market's a master manipulator. It convinces you over and over of one way to buy the dip for the past couple of years. And then just when you're convinced, it changes character. So now the market's in a corrective phase. Unfortunately, a lot of new investors and traders have not seen a bear market or a correction. So they're continuing to buy the dip. And it's going to take some time for that to unwind. If I can also agree with another point that Eddie made, is that the market's a discounting mechanism. So we just have to be patient and wait for this correction to play out. But we could possibly bottom before the economy turns around, because the market tends to trade on what's going to happen 6 to 9 months from now. So when we have to wait for maybe some more bad news to come out, but for the market to not go lower and maybe start to anticipate a turnaround. And in these types of years, mid-election years, the market tends to turn around in the second half of the year.
And Eddie, if you're an investor who bought the dip early, perhaps didn't rotate late last year, how would you recommend minimizing the damage to your portfolio now?
So look, everyone's situation is different, of course, but it's not too late to reassess. I mean, look, the S&P is only down, 10 or 11%? In my opinion, we're not going to get off that easy. So don't just sit there and watch your portfolio go down and down and down, because then mathematically it's going to take you years to get back. It's okay to sell losses as long as they're manageable losses. So from an investor's perspective, when you have big bounces, because in bear markets you do get some pretty sizable rallies, I would look at that as an opportunity to reassess your risk, and at that time maybe take some off the table if you're not happy with the portfolio performance, because I believe the second quarter is going to be worse than what we've just witnessed, because the economic data coming in is just not going to be good. I think, look, most people are talking about a 4% GDP growth in the second quarter. I don't see how there's any way we come even close to that. And if that's a surprise to the market while the Fed is tightening, I think people will wish they would have sold earlier.
You've got lots of good advice there. Thank you so much to our panel, Eddie Ghabour from KeyAdvisors Group and author of Common Sense Bull, and Joe Fahmy, Zor Capital's Managing Director. Thank you for your time today.